What is going on YouTube? Welcome back to another news update. Today we've got 3 stories for you with 5 key takeaways from each. The 3 stories we're covering today include the asset management industry, but BCG, Boston Consulting Group's take on it, how private equity firms and professionals have taken $1 trillion in carry fees, basically share of profits, and the tax debate around this, and the third and final story on how Deutsche Bank is counting big on its most recent hiring spree of investment banking directors and managing directors, and whether it pays off or not. So with that, let's get straight into the video. All right, the first story is the BCG Global Asset Management Report 2024. All right, the first key takeaway from the report is the growth in assets. The global asset management industry rebounded to nearly $120 trillion in assets in 2023, recovering from a decline in the previous year. The second key takeaway is challenges to growth. So asset managers are grappling with increased costs and a shift towards passive, low-fee funds. Efforts to differentiate with new products have largely failed, with investors preferring established products with reliable track records. Slowing market appreciation. So historically, market appreciation has driven growth, but this is expected to slow in the coming years, adding to the industry's challenges. The 3 Ps strategy. So to maintain growth and profitability, asset managers should focus on increased productivity, personalizing customer engagement, and expanding into private markets. AI is seen as a crucial tool to enhance these strategies. And last but not least, the role of AI. The role of AI can boost productivity, enable personalized portfolio management, and improve the efficiency of private market deal teams. Surveyed asset managers expect significant or transformative changes from AI, with many already planning or scaling AI use cases. Asset managers must invest in AI now to avoid falling behind. Doesn't the rest of the world too? Before we go on to the next story, I want to quickly let you know that I've launched a community called Finance FasTrack, and it's for 16 to 21 year olds interested in fast tracking their process to breaking into the industry. It will be linked in the first link in the video description below for you to check out. A few things you can expect from the community are group coaching calls with me on a weekly or bi-weekly basis. There's going to be a growing community for you to network with, other students all over the world from different unis in different positions that you can network with, chat to, connect with, an array of online courses that I'll be putting together, ranging from CV courses, cover letter courses, interview prep, so on and so forth. This type of thing would normally cost £300–500 plus, but you can access it today for less than £9. But be quick, because there's about 60 spaces left, and then I'm going to cap it, so don't miss out. If that sounds interesting to you, hit the second link in the video description below to join Finance FasTrack, and I'll see you on the inside. Now with that, let's get on to the next story. All right, the next story is an interesting one. We've got private equity firms $1 trillion in carry fees and taxation debates. So the first thing, tax avoidance through carried interest. So private capital firms have avoided $1 trillion or more than that in income taxes since 2000 by structuring incentive fees as carried interest, which is taxed at lower long-term capital gains rates. So carry is basically, if you reach a certain amount of profit from investing, then anything above that, you get a share of it. That's carry. So that's important to understand. This obviously brings a lot of political scrutiny and reform efforts. So political figures in the US and Europe, including the UK's Labour Party, are pushing to close this tax loophole. Recent presidents in the US have vowed to end the special tax treatment, but faced industry pushback. In the article, Philippou's research indicates that treating carried interest as income could generate significant tax revenue. His report aims to provide a clear estimate of the potential tax collection from coordinated global efforts. And last but not least, wealth accumulation and influence. The research underscores the enormous wealth accumulated by private equity execs and professionals. This is a key point because these individuals go on to be influential political donors in both Republican and Democratic circles. Investment returns and costs. Philippou's report questions the cost effectiveness of private investment strategies, showing that the median private equity funds returns are comparable to long-term US stock returns despite the substantial fees involved. The American Investment Council argues that private equity has generated significant returns for retirees, aligning investor and manager interests. Before we go on to the third and final story, some of you who are interested in breaking into the world of banking and finance might not know that I've put together career guides on all of the different divisions. Now, typically I would sell each career guide for £20 each. There's 9 of them, that would be £180. However, you can get all 9 career guides plus my Goldman Sachs CV and my Goldman Sachs cover letter, all for 30 quid. Now, if you're interested in that, hit the third link in the video description below And with that, let's get on to the third story. And the final story for today, we've got Deutsche Bank counting on investment bank hiring spree to pay off. 5 things to note. First and foremost, Deutsche Bank went on an aggressive hiring spree in recent times. They recruited 125 bankers since early 2023. This included 75 at managing director level, that's over 350, 400k salaries, and also at director level, so that's at average base salary between 250 and 400k. So that's a lot of money they spent. And then 300 more from the acquisition of UK broker Numis, marking a strategic shift from its post-financial crisis cost-cutting approach. They've had a strategic focus on corporate finance. The bank aims to expand its corporate finance advisory arm, which includes advising on acquisitions, debt and equity raising, and initial public offerings. This move is intended to balance its volatile fixed income trading business. So the trading business, some years it has a good year, some years it doesn't. And so this investing in corporate finance is meant to balance that out. They've also experienced improved performance and rankings. So Deutsche Bank's investment banking fees have surged, ranking 7th in the first quarter of 2024, up from 11th in 2023. The corporate finance advisory revenues rose by 54% in Q1 2024 compared to the previous year. A few notable hires. So key hires include Alison Harding-Jones from Citigroup as Global Head of M&A, Ken Oliver Fritz from Lazard, and William Mansfield from Credit Suisse. Last but not least, Numis acquisition and client gains. Despite some staff departures post-acquisition, Deutsche's £410 million purchase of Numis has led to client wins such as Coca-Cola Euro Pacific and Land Securities Group, reinforcing its UK market presence, despite a recent €233 million write-down on Numis. If you made it to the end of this video, make sure you hit the first link in the video description below to subscribe to my free daily newsletter where I send Monday to Friday free news stories with 5 key takeaways to keep you up to date on what's going on in the world of financial markets. With that, I'll see you in the next video. Peace.